answering your questions about retirement. It's Money Talk with Michael Eastham.
With CD rates at 4 to 5%, I'm thinking about taking money from stocks and putting it into a few CDs. What are your thoughts and what amount would you suggest?
Yeah, we're getting these types of questions a lot these days. So think about it for a second. You can get a 6-month CD that's paying you 5%. You can get a 5-year CD that's paying you 4%. In what financial universe does that make sense? Usually it's the other way around. The longer the duration, the higher the interest rate, because you're committing money for a longer period of time. But here's the interesting question. What does that tell you about the bank's perspective on where interest rates are going? Think about it for a second. The bank is paying you 5% on a 6-month CD, but they're going to pay you 4% on a 5-year CD. That doesn't make any sense. And not only that, but we're in a situation now where it's called an inverted yield curve. That means that short-term interest rates are higher than long-term interest rates. And the reason that's so important is because banks can't stay in business when that's the case. You see, they pay you money based on short-term interest rates, that's 6-month CD, but they charge you interest on a car loan or a house loan based on much longer interest rates. So the long-term interest rates have to be higher than short-term interest rates over time in order for the banks to make money. So back to my question from a second ago. What does that tell you about the bank's perspective on where rates are headed? It's very likely that interest rates are headed down, and that's why the bank's not going to commit to a higher interest rate on a 5-year CD than that 6-month CD. So understanding some of those subtleties can be very, very important. When we're managing a portfolio for clients, then we're actively managing that portfolio, and our goal is to generate income for the longer term. So it's important to understand of the variety of securities and investments that are included in a well-diversified, well-balanced portfolio so that you're not stuck in a short-term situation, so that you can get income for the long run. I always tell clients, you need to plan for a 30-year retirement because it's better to plan for 30 years and maybe only live 20 than to plan for 20 years and live 30. Keep that in mind as you're trying to take a look at especially CD rates today, because it's very likely you're going to start seeing those rates go down in very short order. And give us a call with questions. We'll be happy to help you make some good informed decisions. Thanks so much.
If you've got a financial question you'd like to have answered, click on the link below to submit your question. You may hear your answer on an upcoming edition of Money Talk.